The falling wedge pattern is a technical analysis pattern often observed in price charts. It is considered a bullish pattern that can indicate a potential reversal or continuation of an upward trend. The falling wedge pattern is formed by two converging trend lines, where the upper trend line slopes downward at a steeper angle than the lower trend line. Here are some key characteristics of a falling wedge pattern. Convergence: the price consolidates between the two converging trend lines, with the upper trend line sloping downward and the lower trend line sloping upward. This creates a narrowing range over time. Duration: falling wedges can take various durations to form, ranging from a few weeks to several months. Volume: as the pattern develops, trading volume tends to decline. Lower volume indicates decreased selling pressure and potential buying interest. Breakout: the pattern is typically confirmed when the price breaks out above the upper trend line. This breakout is often accompanied by an increase in volume, signaling renewed buying activity. Price targets: traders often estimate potential price targets by measuring the height of the wedge pattern at its widest point and projecting it upward from the breakout level. It's important to note that while the falling wedge pattern suggests a bullish reversal or continuation, it is not a guarantee. It is always advisable to use additional indicators, confirmatory signals, and risk management techniques when making trading decisions. Remember that trading and investing involve risks, and patterns alone should not be the sole basis for making decisions. It's recommended to seek guidance from financial professionals or conduct further research before making any investment choices. When trading the falling wedge pattern, here are some steps to consider. Identify the pattern: look for the formation of a falling wedge pattern on the price chart. Make sure the upper trend line is sloping downward at a steeper angle than the lower trend line. Confirm the pattern: validate the pattern by observing decreasing volume as the price consolidates within the wedge. This indicates decreased selling pressure and potential buying interest. Wait for a breakout: patience is key. Wait for the price to break out above the upper trend line of the falling wedge pattern. This breakout is often accompanied by increased volume, confirming the potential bullish move. Entry point: once the breakout occurs, consider entering a long position, buying near or slightly above the breakout level. Some traders prefer to wait for a pullback and retest of the upper trend line as a potential entry point. Stop loss: set a stop loss order below the breakout level or below the lower trend line of the falling wedge pattern. This helps limit potential losses if the price fails to sustain the breakout and reverses. Target price: estimate potential price targets by measuring the height of the falling wedge pattern at its widest point and projecting it upward from the breakout level. This can provide a rough idea of where the price may reach. Monitor the trade: keep a close eye on the price action and volume after entering the trade. If the price moves in your favor, consider adjusting the stop loss to protect profits or trailing the stop loss to capture further gains. Risk management: determine an appropriate position size based on your risk tolerance and ensure that the potential reward justifies the risk. Consider diversifying your trades and using proper risk management techniques to protect your overall portfolio. Remember, trading is speculative and involves risks. Falling wedge patterns may not always lead to a successful trade, so it's important to combine pattern analysis with other technical indicators, fundamental analysis, and risk management strategies. It's recommended to practice on a demo account or seek guidance from experienced traders before trading with real money.